The Hocking Homes team.
Hi, it's Ian from the Hocking Homes Investment Real Estate team at Keller Williams here in Barry, and today I'm talking to the investor about valuing an investment property, and we're going to keep this fairly short and sweet, but it's important to understand as a potential investor, or if you've done this many times before, just what goes into valuing a property, some of the basic kind of concepts. So for example, you may hear in the news recently that house prices have been going up a lot, which they sort of have, and that's great for house prices, but does that necessarily mean that an investment property would also go up in value? And the answer is no, not necessarily. The more units you tend to add to a property, the less the property actually corresponds to what's going on in the general market and actually looks more like a yield-based investment. So the valuation of a property is not so much the bricks and mortar, but is how much income does it produce, what's the long-term forecast over a 10, 15, 20-year period, what kind of total return on investment can you get. And we'd likely refer to things like the cap rate, for example, which is a cash on cash return. And that rate is a little bit subjective. It can vary quite a bit, and depending on what that cap rate is, it can make quite a difference to the value of an investment property. So that's really kind of the general gist of the idea. Is it's not so much what's happening in the market, it's how much yield the property produces. There's some calculations that go into that. We use a lot of methodology at the Hocking Homes team to help evaluate properties, and we'd be very happy to sit down with you and have a chat. So if you'd like to know more about valuing properties, by all means give us a call at the Hocking Homes team, and we'd love to sit down and speak to you. Thanks very much.